Before we get to today's chat, just a quick disclaimer. This content is for educational and informational purposes only and by no means financial advice. All investors are encouraged to do their own due diligence and are responsible for their own investment decisions. Welcome back to another go-round worth of Masters of the Market. I cannot believe I was able to get PPC Ian on Masters of the Market, and I'm incredibly excited because he is one of a kind when it comes to dividend investing. But here to tell his whole story is Ian himself. So Ian, welcome to Masters of the Market. And I want to go ahead and just pass you the first question. What exactly is your story and how'd you get to where you are today?
Oh my goodness, Ari, it is such an honor to be here today. Thank you for this opportunity. I know we've been trying to make this happen for a while, and so I'm so glad it finally worked out. And just thank you everyone for having me on the show today. So my name is Ian, also known as PPC Ian. I am a dividend growth investor, and so I invest in companies that pay cash flow dividends that I can use to pay my bills. I'm about 6 or so years away from my financial goals, which are a very kind of more robust financial independence, retire early. I'm married, I have 2 kids, we like to go on vacations and enjoy life, and so having dividend checks cover our living expenses, it's been a lot of work, and so I've been in the game here a long time, investing in the stock market, investing in dividend paying companies, and I'm really excited to just share that journey with all of you today. I think, Ari, you were asking a little bit about my background and how I got started. Well, I've really been intrigued in investing my whole life. It really started probably back in my high school days. Believe it or not, back then, probably rare for that era, but I had some friends who were also investors and kind of got into things back then. And over the years, especially in my early years, I tried all the strategies, whether it was day trading penny stocks or investing in technology companies during the kind of the height of the dot-com bubble, or pretty much anything else. At the end of the day, I kept coming back to dividend stocks because that's what really resonates for my level of risk tolerance and ultimately my financial goals, which are living off of passive income.
And I gotta ask because, I mean, it's been years now that you've been dividend investing, and I feel like, first of all, you need no introduction. You're all over YouTube. You're all over anywhere that's gonna mention dividends. But I feel like you could be like the growth investor Ian at this point in time, or maybe even these days, because there's so many ETFs, you know, an ETF investor. But you've stuck to dividend investing, and I want to get into the rationales behind that because there are so many opportunities now out there where you can almost double or triple the money that you have or go a little bit faster. So what is it that keeps you in the game of dividend investing specifically?
This is a really good question, and I would say there are many different types of dividend investors. So some dividend investors, they're going for very low yielding companies that have growth over time. Others are going for very high yielders, even ETFs, covered call ETFs that pay a lot of cash flow. I'm kind of somewhere in the middle. My portfolio, it's a blend of dividend growth stocks and also some stocks that have higher yield. What has really kept me in the game over the long run, I would say, is twofold. One, it has been being a value investor. And so even within the world of established companies that might not be growing super quickly, I have really built an art and science around analyzing financial statements, analyzing companies, and finding value. And because I try to buy with a large margin of safety, I really grew up learning from Warren Buffett and Benjamin Graham, who was Warren Buffett's mentor. If I can buy with a margin of safety, even investing in kind of slower growth companies, I can see that capital appreciation. I can see that value. I can lock in a really good starting yield because I'm buying below the intrinsic value of the company. So that's kept me in the game. But the other thing that's kept me in the game is being not only a dividend investor, but a dividend growth investor. Because I grow in companies that not only pay, or I invest in companies that not only pay a dividend, but they're growing it over time. And how are they growing the dividend? They're growing their free cash flow. They're growing their business. And so some examples of that might be like Caterpillar. I'm up over 500% on my first investment in that company. Now, by the way, everyone watching, in terms of full disclosure, if I mention a company today, I own it. And also I don't offer financial advice, just sharing my journey for fun and entertainment here. But being a dividend growth investor has kept me in the game because I do see capital appreciation. I am participating in the upside as well. It's not just all about dividend cash flow. It's really for me about long-term yield on cost. What I would say on this topic, because I have experienced capital appreciation, I don't ever plan to sell. So why is that capital appreciation important to me? Well, it probably should not be, but it makes me feel good about what I'm doing, and it keeps me in the game because I know I'm not leaving something behind. I'm not foregoing something. I am experiencing the capital appreciation. But second, it gives me options. Let's say tomorrow something very dramatic changed in my life and I had to sell everything. Well, I have had a lot of capital appreciation, and because of that, it gives me options in life. I don't want to have to sell stocks, but if I have to, hey, I'm up over 500% on that first tranche of Caterpillar, for example. And so there is a delicate balance in the world of dividend investing, and I would say it is possible to achieve huge, massive cash flow while not foregoing capital appreciation. Now, am I receiving tech-like returns in terms of total returns or capital appreciation? Not these days. If you had asked me the same question maybe 4 or 5 years ago, I was keeping up pretty good with the S&P. But I would say in the last few years, the S&P, it's really broken out because of the Mag 7. Now, what I would say, and I know you've got a lot more questions, but I'll just plant the seed here. I now own some tech stocks like Alphabet and Meta, and these, I believe, are some of the great dividend growth stocks of the future. They pay dividends now, and they're growing those dividends over time.
You know, when I bought Alphabet not too long ago, it was a couple of years ago, but it wasn't paying a dividend at first. This is when I was all in on dividend investing. It wasn't paying the dividend at first, and then it came in and started paying the dividend like 2-3 months after the fact. So I did a celebratory dance at that point. But so look, I'm happy to hear you have now some tech players in there, because one of the questions that I wanted to ask you was, seeing the Mag 7 perform as they are, and even some of these other tech stocks, does that ever emotionally drive you in some type of way to want to get into a different strategy for yourself? Do you look at those tech stocks and say, wow, like I'm missing out? Or do you have your strategy so down pat that you just know that this is the way?
You know, it's a complex question. I would say the first thing that comes to mind for me is risk tolerance. Because I've been at the game a long time, I've been through some hard times, some bear markets. Even in my career at one point, I was laid off from my job. It was a very stressful situation. Thankfully, I landed a new job right away. I kind of was already interviewing because I knew some bad things were probably coming. And so I got a little lucky there. But nonetheless, it was scary, and it opened up my eyes. And so for me, I would say being more of a risk-averse person in life and in investing, and having been through just the corporate game and the corporate journey, and as part of that journey, unfortunately, anyone who's been working long enough probably will have to either leave a job or maybe be laid off. These types of things happen. I have a lower risk tolerance, and moreover, when the market plummets, if I see my portfolio plummeting at market rates, it's just not something for myself that I enjoy witnessing. It's pretty stressful. And so I've built my strategy in a way where I can focus on cash flow, something tangible. And even during the pandemic, my cash flow kept growing over time, even in a portfolio which is well diversified. But I had a few positions that cut the dividends temporarily, mainly in the energy sector, because energy prices were just so low back then. But even throughout the pandemic, my cash flow was growing while the portfolio value, it was suffering just along with everyone else's at that time. And honestly, it was a great buying opportunity. But what I would say for me, I don't like a lot of drawdown. And when the market tanks, I want to have less drawdown than the market. So I've built my portfolio accordingly, and I've been through enough market corrections that I know what it's like. I know how bad it can get. I think when I look at the most recent few years, we've been in a pretty aggressive bull market. And so I think it's easy to forget what bad times are like. But I do think eventually those bad times, they always come back. It will happen at some point or another. It might be next year. It might be 5 more years from now. We don't know. But I like to position myself for that and remember the lessons of the past, even when so many people right now might be forgetting some of those lessons of the past. So for me, having a well-diversified portfolio that allows me to focus on dividend cash flow, where I'm only 6 or so years away from my goals, and minimizing drawdown, having diversification. That means the world to me, and it allows me to get over some of these days where I see tech stocks jumping, 10% or more on a single day. But also what has really helped me with this is having exposure more recently. Like why have I bought Alphabet? Why have I bought Meta? Well, part of that, honestly, is to participate in the future because our world is changing right now. And for me, it's not necessarily, hey, I feel bad when the tech stocks are up. Maybe my portfolio didn't perform as well in the total returns that day. But it's more, I don't want to miss the boat on the trends of the future. And I think our world is changing. And a lot of the best practices that worked in decades of the past, some of them will still work. And that being said, it's important as an investor to evolve and to not be kind of closed-minded to what may come in the future with AI. And I would say even as a value investor, there are ways to play that game. One example, I own IBM, and a lot of people think IBM's sleepy, boring company. But what I did back in the day, this was a pre-Red Hat merger, but I like to buy the best quality companies in the world that pay a good dividend. I like to buy them on sale when they're facing some kind of challenge. I didn't know, but I believe there's going to be a solution. I didn't know what their solution would be, but I bought it. And then, hey, all of a sudden Red Hat happens. And I knew at that moment that, hey, this is a good acquisition and this is going to transform the company. And now you fast forward, that was back around maybe 2019. You fast forward to today, IBM has recently hit new all-time highs, and they're a leader in quantum computing. And so and I'm receiving a pretty good dividend on my purchase price, yield on cost. And so there are ways to play the tech game and to future-proof even a more conservative dividend portfolio.
I'll admit right here, right now, I remember some of your videos in 2019, 2020. You were talking and touting IBM.
Yeah.
And in my mind, I go, what does he see in IBM? And I completely, ignored this company. But that just goes to show like quality over everything over time will ultimately give you a strong ROI. Again, should you be investing into that company that is at least putting its footprint into the future? Mm-hmm. But here's a question for you, because you also mentioned the word, which I loved, evolve. As an investor, you should be evolving, and I completely agree with that. Today we have, and I'm assuming it's just based off the amount of product that's out there in the market for investors to get their hands on, but so many new ETFs, a lot of them leveraged, a lot of them paying out with options and 2x and 3x and that X. And it has all the hype. I almost feel like to some extent dividend investors like yourself are quite rare to find, and there are a lot of investors that are solely focused on just income and not necessarily the companies anymore. What's your 2 cents around all of that?
It's a really timely question. So first and foremost, Ari, this is more of just a shout out to you. I remember at Blossom Social Investor Tour Chicago, where we were both presenting and we got to meet in person, how you had presented, hey, my strategy is I'm not going to pick any strategy. I'm going to be open to everything. And that really resonated with me. So first, just wanted to comment on that. I think that's an important point for anyone watching today, that we live in a very unique time in 2025. This is very different than what investing was like even back when you were watching my IBM video in 2019. We're in a different world, pre-pandemic, post-pandemic. Everything has changed. And so I love how you're keeping an open mind. I try to do the same. So the old Ian, maybe back in 2018, 2019, might even look at some of those ETFs that are paying those really high yields using leverage. And I might, kind of just have a closed mind to them. But I would say the Ian of today, I would be open to learning more. And I have friends and acquaintances, people I know in this community, which I love, the Blossom community, the PPC Ian community, just investing in general, your community here on YouTube. I know a lot of people who have retired off of these higher yielding investment ETFs that use leverage and options, and they seem to be doing fine for their own level of risk tolerance. And I commend them. One such example, I was at the Blossom Investor Tour Toronto, and I co-presented with Adriano from Passive Income Investing, and he has a very different style than mine, and we complemented each other really well because he's covered call strategy, I'm covering classical dividend stocks. there's no one right way. Now, for my personal situation, what I would say I've learned over the years is time in the market is big for me. Just having that compounding work over the years. And it's not only with the capital appreciation, it's not only with the dividend growth, but it's with dividend reinvestment. It's with net new capital infused. And for me to stay committed to something, I need to really know about it and I have to be comfortable with it. And I've tried a lot of different strategies just for my personal situation. What I've always come back to is the dividend strategy. It's just what I love. It keeps me, I'm just so passionate about it. It's fun for me. As you mentioned, it is rare these days. I did a YouTube video maybe a month or two ago about the lost art of dividend investing, because I really think what I talk about, it's kind of been lost these days in the conversation. We either have kind of those yield on cost investors who are buying the really low yielders like Visa. I don't own that company, but it's a great company to my understanding that a lot of dividend investors own for long-term yield on cost. We also have the other end of the spectrum where people are investing in the high yielders, but kind of the people in the middle like me who are investing in stocks that yield, say, between 2.5% and maybe 7% in that range, who are growing the dividend over time. It's kind of rare, and it is becoming a lost art. And so that's why I'm so excited to speak with you today and hopefully spread the message. I think it's important everyone performs their own due diligence and determines what works best for them. But I found a lot of value in what I do, and it works for me. I think it's a really solid strategy for those that might have a little bit of a lower risk tolerance, but also want to have those total returns and that qualified dividend cash flow.
Well, I hope in this episode to either re-inspire or inspire all of us to go back and really discover this lost art that you're talking about. So let's go back to the starting line of someone just getting invested into the market. How exactly would you recommend someone go about determining their investor profile and how they should go about investing in the first place because of all the strategies that are out there? And then most importantly, how to narrow out, all of them to find the dividend investing strategy as the pick?
Oh, wow. That's a really good question. So I think if someone is really new to the market, at least the way I did it, and this was back in the day before there was a lot of, or any really internet content. I think back in that day, the only internet content I really consumed on investing there was the Motley Fool website, which had some sample portfolios, and there was Yahoo Finance. And so that was kind of it, but I read a lot of books. And so I think for anyone starting out, one of the best things you can do is probably just sit down and read. I think that reading these days, a lot of people have forgotten that art because they're spending a lot of time here on the internet, which is also good, consuming podcasts and content. But I would say balancing the internet content with just classical books, learning as much as you can. I read so many different books. I read this Technical Analysis Explained, which was like a very thick classical text on technical analysis. I've read it all. I read Security Analysis by Benjamin Graham, The Intelligent Investor, a lot of different books. Peter Lynch's books, Beating the Street, One Up on Wall Street. I would just say consuming content, whether it be books or podcasts or blog posts, and just trying to understand what resonates with you. I think there really is no one right strategy, but what I think is important is finding out a strategy that works in your situation and then staying committed and not getting distracted or lured into things that might just be the shiny new object. Really where the value I've found comes is being patient, because I'll share another stock. I bought Walmart back in the day, like at $16. It's now over $100 per share. But when I bought Walmart, it wasn't going anywhere. I had conviction in it because it was a great company and it was paying a solid dividend, and I just stayed committed to it. But by having that time in the market and not losing interest, not selling and pivoting to something else because, hey, this is getting boring, it's going nowhere, that's how I unlocked all the value. Because what ended up happening is when Walmart really embraced e-commerce over the last few years and it took off, I got all the rewards at once. And that's sometimes how the stock market is. You can invest in a stock or an ETF and it might be stagnant for a while. When the gains happen, They come fast. They come really fast. And so I think it's important to find that strategy and stay very diligent and committed and patient. And of course, there's a little bit of luck in all of this as well. It's an art and a science, and there's some luck. When I bought Walmart at $16, did I know that they were going to embrace e-commerce years later and in just hockey stick in share price? No, I did not know that. So there's certainly going to be some skill and some luck as well. But I would say the luck manifests a lot more for investors who are patient and can kind of be contrarian as well. Buy when others are very fearful. Being greedy when others are fearful, as Warren Buffett would say.
So we literally live, I think, in the most instantaneous gratification society that we've ever been in. I mean, we're talking, fast dating culture with applications. We're talking, you can instantly order something on Amazon. People want their dividend income every day, daily income. So can we train patience? Because, even as you were talking, a funny thought for me pops in. It was like, even marriage today, I mean, divorce rates are up like 50% because it's just like we can find the next thing immediately. And I feel like people are running thin on patience. But to be a good investor, a high quality investor, like everyone talks about Warren Buffett, but I really question when people talk about Warren Buffett, how Buffett-esque they are. Because the one thing Buffett did have was patience, and you have patience. So is that something that as investors we can train, or how do we really develop it?
I think that's such a good question. So I struggle with this too in the modern world. I think one of the reasons I am starting to invest in some of those tech companies is just because of how compelling it is. You can't put it away, and it's like you said, at the tip of your fingers you can order your food and it's there right away, or even just consuming knowledge, it's there instantaneously. And so I'm lucky because I got started a long time ago. And so I think I have the added benefit that I've just been in the game so long. And I grew up in a time which was before the phone. It was before tablets. And computers, it was honestly just starting. And so internet was just starting when I was in my teenage years. And so I have that luxury of having lived in different times, but I would say I probably struggle just as much as anyone else these days unplugging from the technology. And it's something oftentimes that I'm looking for new solutions myself. Like maybe I'll put the phone in a separate room. I'll try to just go into my office without the phone and focus on getting like deep work done and just working on something without the distractions. And so, boy, how to train patience in the modern world. I think it's just discipline. I think it's just old school discipline and working on things like having a more well-rounded life. One of the things I take a lot of passion in, and I could always improve, but is just running. I enjoy getting out there for a run, unplugging from work, unplugging from the tech world, and just focusing on accomplishing something without technology for a while, focus on improving my skills, improving my health. And so I would say for anyone watching today, just knowing that some of the best investors out there, even you look at these angel investors who have made a ton of money getting really early on new companies, and everyone thinks that they made their money overnight, but no, for every stock or every investment where they made 100% or 1000% or more, one, there was a lot of losers, but two, they had to be patient. And most of those new startups, they struggle and they go through bad times, and some of them barely survive to make it to that next level. And so I think just having that perspective and training oneself, I guess, I don't really have a secret sauce on that, though. I think it's really comes back to discipline and just learning those skills.
I say, like, a lot of lost arts can be found in this episode, because even to what you just shared, it's like the old school way of training it. Just put technology away. I think that's arguably one of the most important skill sets any investor can really have. And Buffett always talks about that too. If the market were to shut down, would you still invest in what you're investing into? And you wouldn't be able to look at anything, so you're really just going for quality. And speaking of which, okay, so let's say that investor finally lands on dividend investing, But now we're taking a look at the options out there in terms of the opportunities. And there are just scores of them, thousands of opportunities. Layer that on now with ETF opportunities that are out there. So how would you recommend an investor approaches the market to actually build a portfolio of high quality dividend stocks? What do you look for? What should you look for? What should you stray away from?
So I think a lot of classical portfolio management comes to play, just asset allocation. I think first it makes sense for an investor to understand, well, how many positions do I want to own? How much diversification? How much is the maximum I might want to allocate to each sector or to each stock? And also understanding a blend. How many ETFs do I want as a percentage of the portfolio versus individual stocks? For me, I'm mostly individual stocks. I have some ETFs, but the ETFs over time for me, they will grow. I want that diversification based on where I'm at in my journey right now, just for added stability. But I think taking a top-down view oftentimes is a great place to start, just to understand overall, put it on paper, build a pie chart in Excel. How do you want to construct that portfolio? And then I think once you start drilling down into individual asset classes or sectors, looking for the best companies in those sectors. For me as a dividend investor, usually what I'm looking for are what are called the dividend aristocrats, and those are companies that are in the S&P 500. There's a few other metrics. They're of a certain size, and most importantly, though, they've increased the dividends for 20 years consecutively or more. And also there's the dividend kings, which have increased their dividends for 50 years or more. Now, I wouldn't limit myself solely to those aristocrats and kings, because you might miss some of the aristocrats of the future, like Alphabet, which just started paying a dividend and had its first dividend increase ever. I think next, after having a short list of companies, I'd say another way is just what companies are you familiar with? I like to keep it simple. One of the things I learned from Peter Lynch, who's a very famous investor who managed the Fidelity Magellan Fund, which was one of the most successful mutual funds of all time, huge compound returns over the years. He just liked to look at new trends and look at the household names. What are the new brands or the brands that I use every day? What are the brands that my wife would suggest, or my kids? Or I see my neighbors using this product. I see it at the mall. I see it at the grocery store. And so just keeping an open mind of what type of brands and products and companies are you already familiar with. And so once I have a short list of those, I start looking just at metrics. I start educating myself on the balance sheets, the income statements, the statement of cash flows, the financial metrics, some of the basics. Just, do they have too much debt? Do they are they trading at a good value range? Do they pay a reasonable starting dividend yield? What are their growth prospects? Are they increasing their revenue and their net income over time? And so I start kind of familiarizing myself with companies and placing them on my watch list. And then what I do is I'm just patient most of the time. And I wait for something really bad to happen. I just wait, okay, this company I love, I understand it, I'm familiar with it, I've done my research. Let's just wait. Let's be patient. And a great example is Alphabet. I went really heavy on it in Q1 this year because, okay, all of a sudden there's drama over Chrome. And is Chrome going to be separated from this company and separated from the Google suite of products? And if this happens, it's obviously bad. Can they overcome it? Sure. I'm sure they'd be fine. But I waited, and usually what happens in the market is it will overreact to news. On a stock by stock basis. It's a little more rare with stocks like Alphabet because they're so big and they're so well covered by the analysts that honestly those stocks can be more efficient. So with smaller companies that are less well covered, you can see more inefficiencies. But anyway, earlier this year in 2025, when Alphabet stock was way down, I really believed at the time, hey, I think the market is overreacting here. The market gets moody. It gets too moody on the downside and on the upside. And I see a buying opportunity in a stock that I've already done my research. I already want to own it. I already know I need more allocation to tech. I know exactly how big I want to build it in the portfolio. I'm very familiar with all of the metrics. I don't need to do my analysis on the spot because I've already done the analysis. I'm just waiting for a good buying opportunity. And when it presented itself, I knew right away, hey, yeah, I'm buying today. And so that's really I'm throwing a lot at the audience right here, and I don't want to scare people away from what I do, because it may sound more complex than it is. And look, it is complex. I've done this a long time, so it's really easy for me. But what I would say is, this isn't that hard. I don't believe like a fancy degree or a college education is required for what I do in the modern world. There is more for someone who is self-motivated and wants to put in the work, wants to learn from the podcasts, from the social networks, from the events like we were at in Chicago with Blossom Social, or they want to learn from traditional books. If you put in the work, you can do everything I just said and probably do it better than I can. But that's what I wait for. I love the fact that in investing, it's not only a science, there's an art to it as well. And I like the art more than the science. The art really comes into play in the emotions. And this market that we live in, unfortunately, or fortunately for value investors, it's just so emotional. All the time, either a stock will overreact on the downside or the upside, and oftentimes ones I already own, and I just wait for those values to buy.
So you mentioned, when you're taking a look at these stocks, okay, you're waiting for that opportunity. There's a pullback, and now there's your big shot. There's the opportunity. Yeah. But don't your emotions get a little, mixed up as well? Because sometimes you can see the Googles of the world falling, and you're looking at it, and one, it's like, do I get in now or wait a little bit longer? Mm-hmm. So how do you know when to pull that trigger? And two, what if it just doesn't recover?
These are good questions. So I would say I have a few answers to this. One, I'm very fortunate because I've been in the game now for so long that I have a lot of built-in gains in the portfolio. So I'm up so much that it's kind of like if I buy something now like Google and it gets cut in half again, and say it's only a few percent of the portfolio. Google for me, it's only like half a percent or something at this point. I don't even look at it. It doesn't bother me. So I have that luxury. So for the audience, I need to put myself in the mindset of, what if I were starting over today? Yeah, I think it would affect me. I think that's something that's really important for people to recognize, that investing, as with anything in life, it's harder when you're getting started, because when you're getting started, you don't have the luxury of someone like me who's been in this for a long time. I own Altria stock. I bought that all the way back at $15.99, and now it's at like, I don't know, in the 50s. But my yield on cost on the first tranche, not even counting reinvested dividends, is 26%. I'm receiving 26% just in dividend return each year on it. And so I'm getting my initial investment back every 4 years just in dividends. And so I have that luxury. If I were starting over, and even if I weren't, I'll tell you what I do to this day. I dollar cost average. So when I was buying my Alphabet shares, even though it was way down, hey, I bought some of those shares at like $190, but some of them I remember were in the $140 range. And so I didn't just put all the money in overnight. I kept buying slow and steady over time. And I realized that, hey, whether I'm buying at 190 or at 140 or whatever it is, 10 years from now, it probably won't matter. Both of those in 10 years will probably look like those Altria shares I bought at $15.99. I believe it's going to do so well. They have so much going for that company beyond Google search that the market is not even reflecting that. I have that conviction. And so, but yes, I think if I were starting out and I saw something I bought get cut in half overnight, it would probably affect me. I would say the other way, though, that I compensate for that in my own portfolio, of course, not investment advice, but I like to diversify and I like to have ETFs. I think if I were starting over today in 2025, I would have a lot more ETFs as a percentage of my overall portfolio, maybe half. Right now, I think my ETFs are maybe about 4 or 5%, and I'm trying to get that up to 20%. My percentages move really slow because I have a more mature portfolio, and so when I put capital in, it doesn't move the needle so much as when it was 10 years ago, And so I've been doing this, longer, and just making any change in the portfolio, it just doesn't move as quickly as it used to. But I think diversification is key, and dollar cost averaging is key. And I think perspective is key. Just realizing, hey, 10 years from now, you might be sitting in my position, or hopefully a lot better. Because look, I've made so many mistakes, and I've had so many, I shouldn't call it mistake, expensive learning lessons over the years, that they, hopefully because of all the content that's available today, that people learn from others like myself and what worked, what didn't work. But I think also conviction, that was the last thing I wanted just to say, is if you do your research, just have that conviction and that belief in yourself. I think in the modern world, it's easy to get pulled in other directions. And you have people online saying all kinds of things like, hey, you made a mistake, you're wrong, I'm doing this. No, just remember, look, these are all good opinions and you want to take it all in, but believe in yourself. Ultimately, it's up to you. And that's what I always try to remind people, that some of my best investments I bought when others are saying, don't do it. And it's hard to fight that. It's real hard. You have to kind of respect those opinions, but also tune them out.
I love the advice, and I would say it's arguably the hardest point in time now because of social media. Love Blossom, which, by the way, everybody join Ian and I on Blossom. We're there. Portfolios are there, transparently shared. And you can DM us and many other investors who are out there, so it's always good to have a community. But I mean, think about that. Just even on Blossom, you can post something and you're going to get 10, 15, 20 different responses and opinions. And how do you filter those through your mind just to make a solid decision could be overwhelming. But something else that you were talking about, which first of all, I got to say, sometimes I'm listening to you drop the prices of the stocks when you first bought them and you're like, at $14.50. And I'm like, wow, we just don't see those prices anymore. But okay, so when you were buying those companies, obviously you went for the quality, and there had to have been as well at least some other fundamentals that you were maybe looking at when you first started, or were you really just looking at it because you said, hey, great product? Because I guess the real question here is, do investors have to go so deep into the fundamentals and the balance sheet, or is it really as simple as saying, I like Coke, let me just invest in Coca-Cola?
Yes. So I probably go more deep into the fundamentals than most investors these days do. I don't know if what I do is necessary. I do it because I love what I do and because I'm an online content creator. So that's part of it as well. One other thing I just want to mention on that last point, kind of the last topic, you triggered my memory. With Blossom, and also just how so many portfolios and things are being shared, because we're both content creators. Content creation right now in 2025 is a lot different than when I started on YouTube. I started way back, but when I really got serious about it, like in 2017, 2018, the pace. There's more content created now than ever before. And I think even content creators like yourself and myself, we're creating more content. And so just a friendly reminder to everyone watching that sometimes because there's so much content, you might feel like you're being pulled in different directions. But again, remember to be true to your own conviction and your own strategy. But going to your new question, the first thing is I do not mention these prices to brag. I hope that it comes across as motivational, and I do want to really emphasize that I am no different than anyone else watching. I have had so many setbacks, and so I do share the successes to share what is possible, but also I have faced setbacks. But also what I would say is time is so amazing, because time can even improve and make a bad investment look great. And so it's just years in the game as well can solve a lot of things. But no, when I invest, I like to, I don't think there's any one or two things I look for, but I can give a list of some of the things that really matter to me. So one, I'm investing with a time frame of forever. I have sold stocks, usually when we're buying a residence or something like that, and hey, I have to sell it for a down payment. We're past that stage in life at this point, so thankfully I won't have to sell again, but I have had to sell at different times in investing. But because I have a time frame of forever, and I generally have told myself that, Ian, if you buy something, you're not going to sell this. Now, there are corner cases if a dividend's suspended, if the fundamentals just deteriorate so bad and that's going to happen. No investor is perfect. in any portfolio, there's going to be losers. It's just a fact of what it is. And if you invest in ETFs, maybe you don't see the losers because the ETF manages it, but there's losers in there in the ETF. It's part of the game. No one has a crystal ball and can see all of the future. But I try to buy those companies that I believe have the staying power. And so what kind of iconic brands, businesses have such defensible moats that they're not going anywhere? I would say with the sin stocks like Altria, one of the easy picks, that was one of my earlier purchases. It was just so easy because I know there's really no new entrants coming into this market because it's so heavily regulated. And so it's kind of a monopoly business of sorts. And it pays a great dividend. The financial metrics, the margins are really high, and the dividends are huge, and the dividends continue to grow. And there were some other reasons as well. But I would say a lot of what I do comes down to finding companies that I believe can stay in business forever or as long as possible and can continue to grow the dividend over time and can be something that I can continue to hold even if I don't have a ton of time to analyze it, feeling that, hey, I know that this, even 10 years from now, it's probably going to be okay. Part of that in the early days was just philosophical for kind of just how I am. I'm very disciplined, and I have a very long-term focus on what I do in life. But more recent years, now that I'm married and I have a father, or I am a father, I have a father too, but part of that comes down to the future. Hey, one day if I'm not here, well, what is this going to look like? I'm trying to build something of a legacy. And so I try to design the portfolio with positions that can stand the test of time. I'm sure the future generation, they're going to be even better than me at what I do. That's how it's supposed to be. Every generation is supposed to do better than the last. I get scared about that sometimes in our modern world, the way things are looking sometimes, but we got to remain optimistic. But anyway, I try to build the portfolio so as a father, I can pass something to the future that can stand the test of time.
It really is an infinite game versus the finite game mindset. You know, and it's a phenomenal book, The Infinite Game by Simon Sinek. I reference it all the time because as an investor, I mean, very similarly to what you just shared, it's like, hey, you should be investing in stocks for forever holds. You know, that means that those businesses should be high quality. Sometimes when I post a video, or definitely, you know, back when I used to create a lot of the dividend stocks or stocks to buy now videos, I got a certain question in the comments, and you may have gotten it as well, but people are always looking for a quote-unquote cheap stock. And, you know, sometimes you'll post a video or maybe a tweet out there, and someone will look at that stock price and see, I don't know, 150 or 85, and they're sitting there as a beginner typically, or more novice, you know, somewhere in that realm, and saying, oh, that's way too expensive. Can you post about a stock that's like $20? What would you share with those individuals and that type of mindset around looking for quote-unquote cheap stocks?
I love this because as a content creator, you know as well as I do that like there's certain buzzwords that just kind of drive the click-through rate on the video, and one of those is cheap stocks because everyone wants something cheap. They want a discount. They want to feel like they're getting something for free or at a heavily discounted price. And so you'll see so many videos out there with the word cheap, including many of mine. But I also get what you're saying. It's not only just about value. It literally is about price. Because certain stocks like Meta right now, which I kind of feel is, I don't know if it's cheap, but it's for Meta, I think it's kind of a value. And if it goes down more, certainly it will be. But it's not cheap. The share price is in the $600 range. And so to buy just one share, that is a lot of money for most people. And so oftentimes investors are looking for lower priced shares. It's hard. I don't look at things that way because whether a stock is trading for $600 or $20, the $600 stock may be cheaper than the $20 stock because what it really comes down to is the valuation of the business and what it's trading for. And right now, Meta on a forward basis, even though the price is in the 600s, I think that forward PE is like in the mid to kind of low 20s, which is pretty low for a company that's growing its revenue, I think in the most recent quarter at like 26% year over year. And they're investing in making big investments in the future. Talk about a defensible moat. No one likes their CapEx of the $70 billion a year range, but I love it because I know what they're doing is building a defensible moat in the arena of computing power and AI. But anyway, for me, I feel like Meta, it's not super cheap. It's not deep discount value, but it's a little cheap here, in my opinion, as compared to where it was. But you could find a $20 stock that is overvalued. It could be a company that's not growing at all. It could have a PE ratio of price earnings of like 28. It could have a lot of debt on the balance sheet. It could have very thin margins and not much future prospect for growth. I would call that expensive. And so what I try to educate the community is to really look not at share price, but to look at the valuation of what you're getting for what you invest. And I would also say, let's say you could buy a stock for $100. You could have 6 shares of that or 1 share of Meta. Don't get caught up in like share counts. It doesn't matter how many shares you can buy. If you can only afford 1 share in total of something that is a lot, trades at a high share price, there's no difference between that and owning 6 shares of something that trades at $100. It's just a function of how many shares are outstanding, the aggregate market value. What you really want to look at is the value you're getting for the money invested. Now, of course, I understand that some of the high quality businesses in the world, sometimes it's not obtainable, because even now with Alphabet, I don't know where the share price is, but is it like 300 or something? And a lot of these share prices have gone up quite a bit. A good example is Caterpillar. That one is now, I was just celebrating that it crossed 500, but now it's like 560 or something. This is a lot of money. What I don't know if this is always possible in all countries around the world, but in the US, at least for the US audience, there are brokers that allow you to buy fractional shares. And so that's something to look into. If you can't buy a full share, that's okay. You can buy a fractional share. And even so, if you don't have access to such a broker, what I would look at are some of these really old school avenues like dividend reinvestment plans. And so most companies out there, I would say all companies, typically they have what's called a transfer agent. And the transfer agent is usually a third-party company that manages their stock. And oftentimes the transfer agent will offer what's called a dividend reinvestment plan or a direct stock purchase plan. These are plans that they aren't very popular anymore because they're kind of things of the past. But I know for some investors, they may still be relevant because you can buy, not all of them have plans, but the companies that do offer such plans, you can invest a fixed dollar amount and buy fractional shares. And so if you have no access to a broker, which will offer you fractional shares, you may be able to look that old school dividend reinvestment plan route.
Now, let's talk a little bit about portfolio construction, because while all, the whole hype around picking the highest quality dividend stocks is all the buzz, there also comes this aspect of building the perfect portfolio. And so some investors go with less is more. Some go with, on the other side of the aisle, the more stocks, the better. Diversification. You get all these buzzwords that are thrown into this mix. Where exactly do you stand, and what would you suggest for somebody who's trying to build that quote-unquote perfect portfolio in terms of how many holdings should be in there, the dividend yield itself for the overall portfolio? Like, what are some of the healthy numbers around portfolio construction?
Another great question. So I don't think there's any perfect answer. For my very personal situation, obviously not advice, I like to have diversification to be able to sleep well at night. I also like to buy stocks called swan stocks, sleep well at night. It's just part of my strategy. But I don't think you can have too much diversification, especially as a portfolio gets larger. As long as you're a good financial analyst and you select wisely. I think it's easy to diversify if you're just randomly picking stocks without doing the homework. And so I would say that's something really important to keep in mind. But Yeah, I really don't think there's one right approach. I would say for my personal situation, I couldn't see myself, like even in my early days, owning, say, fewer than 5 or 10 stocks. I think when you get fewer than 5 stocks, especially, that's pretty focused, and that's taking on quite a bit of risk. But I think once you get kind of over 10 stocks, and especially if there's an ETF or two in there, that's probably plenty diversification. I think at the point I'm at where I have like 42 positions, it's probably too much. But the main challenge I have is I just keep finding great businesses and I want to own them. And there are so many great businesses in the world where there's way more than even the 42 positions that I have. And so predictably over time, I may own even more. I probably should adopt a philosophy kind of like keeping a clean house. Like sometimes to keep your house clean, if you bring in some new items, get rid of the old. I don't really do that because there's really no, at this time at least, maybe there's a few stocks in the portfolio that could be doing a little better, but I don't really have any that I want to get rid of. And so I am a bit of a stock collector. But again, if I were just starting out again, usually I would say my bias is to keep it concentrated, because over the years, the natural kind of progression of investing is you're just going to own more positions. And so if you don't actively fight to kind of keep it concentrated, the portfolio is going to get way out of control. And I think it's the same thing, just anyone in this modern world of consumerism, it's just like managing your household. Again, if you don't actively try to like keep things under control, you're going to end up bringing all this junk home, and it's not going to look good anymore, and it's going to be too much mind share and overhead. And so it's the same thing with investing. I would just say the bias for me, and I would say I would suggest for anyone investing, is be very intentional what you're doing. Now, for dividend yield, again, I don't think there's any right range, but I can say my range has always been in the 3s. Like right now, my portfolio on a current yield basis is averaging 3.6%. And the reason that it averages 3.6% is I want future growth, not only in total returns, but dividend growth. And so I'm skewing towards businesses that offer growth. And when businesses offer growth, they tend to offer lower starting yield because they're still growing. I have a few higher yielders in the portfolio, like Altria, for example, but I have some real low yielders like Alphabet. It all kind of comes out to being about 3.6%. And I would say also, though, that's lower than my kind of recent range. Usually my portfolio, it's kind of yielding about 3.8%. The reason right now it's only yielding 3.6% is I think the portfolio value is elevated because some of the stocks I own, quite frankly, are overpriced. I think the market has gotten on some sectors a little bit ahead of itself. And so it's kind of indicative as well of a possible upcoming correction, at least in some of the stocks that I own. And so I always like to look at portfolio yield, because when the current yield gets higher, say my current yield was 4%, I know my pie, if it was at 4% right now on the stocks that I own, I would feel like, hey, we're kind of in a pretty good value market. I don't think there's further downside ahead. It's probably a good time to be buying. But when I see my portfolio yielding like 3.6%, I'm like, yeah, these stocks are kind of heavily valued right now.
It's fascinating. You know, you mentioned before, if you were to just start out all over again, you'd go a little bit heavier in the ETF direction. Mm-hmm. And then you mentioned just now that if you were just starting out all over again, you would be a little bit more, I want to say not less diversified, but, mm-hmm. At least just more, 10 stocks, I think you mentioned mm-hmm. you'd have in the portfolio. So powerful lessons there, because you've been investing for quite some time. And then you mentioned at some point earlier on that there are plenty of mistakes that you made on your journey. So I'd love for you just to mention like one or two of those biggest mistakes you feel that you made, although, again, never really a mistake because they're just really learning lessons. High tuition bills might be paid, but at the end of the day, that bill is going to be due in order to make the investor that you are today. So what were some of those bills that you had to pay because of the moves that you made?
I would say a big one that and this is very relevant. It was a totally different era, but yeah, back when I was in college, between classes. Even I skipped my lunch and I was day trading penny stocks. And back then it was before like YouTube videos, so where all the insights were coming from were the message boards. And so I'm looking at the message boards, I'm trying to figure out like what other people are doing, which penny stock's going to take off. And a lot of that was the genesis of what I was doing was kind of trying to get rich quick, trying to make big returns really fast. And I think there is some of that I see these days in different ways. That are manifesting in many different ways. It's not just penny stocks these days. It might be taking on too much leverage. It might be investing in too much volatility. It might be over concentrating on any one position. And so I think the most important learning lesson I've found is that yes, some people will find ways to get rich quick, but in general, for the vast majority of people, I don't think investors this day are emphasizing capital preservation quite enough. And it is possible to lose money. Yes, in the market of 2025, it hasn't been that way, thankfully. It's been a very solid bull market. But I just want to remind people that don't forget about capital preservation and that you worked hard for that money that you're investing. And earning capital, you know, when you work an active income job, it's not easy. And so you want to respect that capital and not only grow it over time, but preserve it. And I think also the big lesson from that is time in market can solve a lot of things. And so just finding a way to get an active income job or career or starting a business or being a content creator or something that you can do for a long amount of time while you wait for your portfolio to build is going to be important. If you're just trying to retire overnight, that probably, you know, for some people, there's always exceptions to the rule. But I would generally say that consider, especially if you're younger, finding some kind of career that you can stick with. And it's not always easy because a lot of active income jobs, look, one of the reasons people invest in dividends is because they're trying to break free from the rat race. All of us have that dream in dividend stock investing, but if you can find something that just allows you to stay in the game a long time, that's going to be key. I'd say another big mistake I made, and this one wasn't as much to make quick returns. It was more out of personal like vanity or kind of getting caught up in the hype, which I also think is very relevant today. This was probably back, I'm trying to think of when this happened. It was probably back in like right before the pandemic, so maybe like 2018, 2019, I made some pretty large, for me, angel investments. And I did that at that time because I wanted to keep up with the hype, where I saw a lot of kind of colleagues from different jobs I had worked or just personalities online who were like, wow, you look really impressive. You're an angel investor. And it's like almost a badge of honor. They would put it on their LinkedIn. And not only did they invest in one company, but they're like, I'm an investor in this and this and this and this and this. Look at me. Look how cool I am. And hey, I wish them the best. Maybe they made a ton of money at it. But I saw that. And the way I interpret it is like, shoot, I'm falling behind here. I'm not keeping up with the Joneses. My LinkedIn doesn't look like that. Why can't I do it? So I threw money at a bunch of angel investments. And what I learned through some of that was that most of them did not work out. I still have some that are kind of hanging on. And one of them in particular where I'm really hoping it works out. And maybe it will end up paying for all of them. Who knows? But what I think is it's a very important lesson right now for everyone, because I would say for anyone watching, don't try to keep up with what others are doing. You have to live your own life. And what you see on the internet, what you see on LinkedIn, it's not always the full picture. Oftentimes it is, and maybe it is the full picture, but it's right for someone else doesn't mean it's right for you. And so you just really have to spend the time unplugging from the technology, trying to really look honestly, like what is your risk tolerance? What are you trying to accomplish? What are your goals in life? How much money do you need for that? Just kind of like financial planning 101. And what kind of risk are you willing to take? I think a lot of people kind of overestimate what their real risk tolerance is. And once you really lose money, you kind of get to know what your risk tolerance is. And so I'm thankful for those opportunities that I've had to lose money in angel investing because I learned from it. But yeah, I think the big lesson for me is just live your own life, and it's okay if you're not, maybe you feel like you're not the same as someone taking a different path. It's completely okay. And sometimes in dividend investing these days, it gets really lonely, but it's all good because I found something that works for me.
Ian, we were obviously both just on tour together, with Blossom, and we got to mix with the crowds that were there at each stop, and there's a lot of words being spoken by a lot of different investors. I'm curious just to know if when you were chatting it up with other investors at the events or even on stage, some of the questions that were thrown your way, was there anything that particularly got your attention that maybe you didn't say at that event because you didn't have time or you didn't want to hurt anybody's feelings, but you can objectively just say it now?
Yes. So there are a few things. One was what I already mentioned about you. I feel that comment you made about not choosing one investment strategy for life, that really resonated with me. That was huge. But there were a few others. So the other one was in Toronto when Mark Beavis was presenting on a panel. I think it might have been the closing panel. He spoke about his experience investing in Microsoft. I don't own Microsoft stock, but obviously it's one of the best performing stocks. But when Mark first started buying it, or in his earlier days, a lot of people don't realize this because I've used this example a lot, but what I love is Mark actually lived this. Between the years of kind of 2000 and I think it was like even, I don't remember the exact date, but it might have even been like 2016. It was like there was a good 15 or 16 years where Microsoft was trading sideways. So investors had to really wait it out. This is the iconic example of patience. I had my Walmart example, but I only had to wait maybe 6 years of it going nowhere. There were investors in Microsoft that had to wait like 10, 15, 16 years of nothing just to now be up hundreds and hundreds and hundreds of percent because all of the gains happened recently, last 10 years or so. And so Mark lived this. Mark is Brandon's father, and Brandon co-founded Blossom. I have so much respect for Mark, hearing him tell that story in real time, that he had the conviction to hold it. And that was amazing because I've used this example so many times on my channel or in conversation to educate just what patience means. But here is a old school investor who has many more years experience than I do, who lived it. And I thought that was huge. That was huge. I would say also there were just so many things that came out of this experience. I think one, some people might have noticed I've been producing more content lately. One of the reasons is I was inspired. I think a lot of the people at the conference were maybe just filled with going into it more energy than I've had. I've been in this corporate world a long time, and sometimes over the years it's just you get stuck in a routine. But to break out of my comfort zone and be in an environment with creators who are doing so much more than I am, and to see that, it blew my mind. And when I went home, it influenced me to just see what I'm capable of. Like, what can I do? I'm like, wow, they're doing it. I can try this. Maybe I'm not going to be as good as they are, but I can do my personal best. And I've put some different things live, and I'm like, even after it's live, I'm like, wait, the audio on that was terrible. What the heck? I messed it up. But it's okay. I'm a perfectionist, but I got to learn to be okay with some level of non-perfection. It's a learning lesson. But I'll just give some names like BD investing. Just seeing like what he's doing with his community, with the tech stocks, with social media, with Instagram. It's so different than what I do, but I've learned so much from him. More than that, just the level of kindness. Like, one thing I took away that I didn't get to even fully thank people at this event is just like, I'm PPCE and people know who I am. I've got a lot of views and stuff, but when you compare what I'm doing to some of these other creators, like I'm just like a pretty small channel here. Like, this is nothing compared to some of these creators. But the fact of the matter is, they didn't look at it that way. They didn't look at it that way at all. They're just there to share their knowledge, to motivate, to inspire, to help others, including me. I'm still, like I said at the beginning of the interview, I'm still going through this all, just like anyone watching. And so sometimes you watch us on YouTube, you watch us on the internet, and you're like, you know, I even had someone like say they were at the Chicago event and they put in the comments, but I didn't come up to you because I didn't quite feel comfortable. And that's okay. I get it. I've been there too before. But what I'm trying to tell people is, look, we're all the same. We're all going through this and just learning from each other. And so I felt like just the level of sophistication, energy, kindness. I was really touched by another content creator like Joy E, her story, and how she said in front of the whole audience in Toronto, I was like kind of kicked out of my house. You know, I think she said by her dad, and then I had to figure it out. And how did I figure it out? I got into investing, and I got really good with money really fast. And I got into content creation, and now she's built like an empire of content creation. And so just these kind of motivating stories where it's like, sometimes I have gripes about life, and I'm like, wow, I wish I didn't lose that money in angel investing, or wow, my boss is coming down hard on me today, or I wish I didn't have to deal with these coworkers who are like trying to undermine what I'm doing, and I feel like I'm stuck in my career. But you see what other people have been through, and I'm like, well, I haven't had to go through something like that, but nonetheless, even having gone through something like that, look what she's accomplished. And so this is what I would just say is, man, it's a special time here in 2025 to be an investor, and something really special is happening with Blossom Social, but I would also say just with content creation right now. And it's some cool stuff. So I just encourage everyone watching to reach out to us, have that conversation, and realize like we're all in this game together, and I have a lot of optimism. I have a lot of optimism because I'd say the other takeaway, I know I'm rambling on, but this is really important because sometimes in life you're not surrounded with the right people. You're not, and we've all heard this so many times. You're like an average of who you surround yourself with, and thank goodness I have an amazing wife and kids and family, and so I'm blessed to be my immediate surroundings are good. But I don't know if I'm always surrounded with the caliber of people that I ran into at Blossom Social, including people like yourself. And when I went home, I kind of felt that. And it just gets you thinking, like, how can you be more surrounded with the right people? Because if you are, your life, money, success, just even putting that aside, just other aspects of life, it's going to be so much better. And so you start having those deep thoughts. And so some of those events are really life-changing for me, just to think and contemplate a lot of these things. It's amazing.
Powerful words, and it just leaves me in awe of what I feel the future holds. You know, as you're sharing so many optimistic words. I have one last fan favorite question for you, but just before I ask you, I gotta say it, and probably many of us are already subscribed to your channels, but you are making a lot of content, as you shared, a lot more content. Yeah. And I've seen Ryan and I also spoke about some of the more recent videos you made. They're hysterical. So highly just want to shout out Ian while he's with us and say, if you're not subscribed to his platforms there, whether it's on X, Instagram, of course, YouTube, Blossom, you have to follow Ian for his insights, but also his humor. It is just too good to pass up. But with that, Ian, I want to ask you this last fan favorite question. If I were to toss you $10,000 right now and you had to pick just one dividend stock to throw it all into, which dividend stock do you think it would be, and why?
I love this question because, first, thank you, Ari. Your words really mean a lot. It's an honor to be here today with you, and just the support you've shown to my channel and what I'm doing. It's humbling. I really appreciate it. It means the world, and all of the same positive words back to you and to anyone who watches PPC, Ian. But this question, honestly, it's a little easy for me now. I wish it weren't so easy because I like being put on the spot sometimes. But I'll tell you, there's another creator who did put me on the spot with this question, and I really didn't have a good answer. And I just kind of came up with an answer on the spot, but it was the right answer. It's Alphabet. And I'll tell you, we are, when I started out, I put all my money into the Sin stocks. This is back in like 2009, and I'd started even before that, but that's when I really started earning a lot of money that I could invest, and I put it in and all that. We're in a different world now. When I look towards the future, and I look towards my goals, buy and hold forever, yield on cost, patience, defensible business moat, opportunity for huge growth, opportunity to pass it on to the future generations. So Joseph Hogue, Bowtie Nation, he put me on the spot with this same question, and I answered Alphabet. And then I was thinking about this. Literally, I was like almost kicking myself. I'm like, Ian, you're a dividend investor. What are you doing here? I went home and I was like, am I being untrue to myself? Like I was like, I was really like having a problem with this. I was like almost up at night. I'm like, I wish I could go back and redo the interview. Oh my goodness, he's going to post this on the internet. Like, what did I do? But then I was like, one morning I woke up and I'm like, I was right. And so that's why it's so easy for me to answer this now. It would be Alphabet. Now, would I be buying where it is right now? Yeah, if I had to, I had to, because I'm looking out forever. And but I would prefer if the market would correct a little and be a little cheaper. But even so, if I just could pick one and I had to feel good about it and sleep with it, it wouldn't give me the cash flow I need. That's for sure. But long term, it probably would. 20, 30 years from now, it's just that would be a long wait. But it is what it is. And so I just think for me, I couldn't find a better quality for my personal situation if I had to take on that kind of risk of putting everything in one stock.
Very powerful. You heard it here first. PPC Ian going all in there with $10,000 on Alphabet. Ian, thank you so much for joining me on Masters of the Market. Investors, of course, you know where to find Ian all over the place, anywhere where dividends are mentioned. And until the next go round of Masters of the Market, we will catch you all there.